Today, the world is changing at an ever-increasing pace. Megatrends like autonomous driving, connectivity, rideshare, and cleaner driving impact how we get from point A to point B. No matter what the mode of transportation, there is always the need for an efficient propulsion system. And that's exactly what BorgWarner has been doing since the earliest days of the automotive industry. We create innovative mobility technologies that reduce energy consumption and emissions while improving performance. Our proven track record has made us an industry leader in forward-looking propulsion solutions for combustion, hybrid, and electric vehicles. For combustion engines, our focus is on improving fuel economy and reducing emissions. From efficient gasoline and clean diesel to stop-start technologies, we deliver fast-to-market solutions to move millions efficiently and cleanly. In hybrids, we apply our knowledge of combustion and electric vehicle technologies to develop solutions with our customers that integrate this expertise into their vehicles. With mild, full, or plug-in hybrid technology on the rise globally, the possibilities of potential drive architectures have flourished. For light vehicles as well as commercial vehicles, our creative solutions allow automakers flexibility in committing to propulsion technologies. With an equally comprehensive product portfolio, we offer vehicle manufacturers across the globe advanced solutions for all concepts. Today, we're making the switch to highly efficient electric vehicles and the potential for emission-free mobility easier than ever. Our product portfolio already covers virtually all the fields of technology that are critical to electric vehicles, including electric motors, power transmission and power electronics, to thermal management. Today, BorgWarner is a global company positioned close to our customers throughout the world. With passion and creativity, our employees have developed true partnerships with customers and suppliers to gain a deeper understanding of their challenges and help them find the solutions to build vehicles that support a cleaner, more energy-efficient world.
Good morning, everyone, and welcome to 2017 BorgWarner Investor Day. For those of you that don't know me, my name is Patrick Nolan, and I'm the Head of Investor Relations at BorgWarner. I'm going to be giving you a brief overview of our day before I hand the presentation over to James. So first, I need to inform you that we will be making forward-looking statements during today's presentation, and those do involve risks and uncertainties as detailed in the Safe Harbor statement on slide 3. But now on to today's agenda, which I'm excited to share with you all. First, James Verrier, our President and CEO, is going to give an update on our progress towards our combustion, hybrid, and electric goals. After James, Christopher Thomas, our Chief Technology Officer, is going to give an update on product leadership, as well as highlight some of the products that we have on display in the lobby. After Chris's presentation, we're going to take a short break, approximately 30 minutes, and that'll give you time to view the products that we have on display. We have engineers available during that period of time, and management will be available for your questions as well. We're going to come back from the break with Ron Hudzinski, our Chief Financial Officer, and he's going to give you an update both on our financial policy as well as key aspects of our financial outlook. After a quick wrap-up by James, we're going to open it up for Q&A, and we should wrap the formal part of today's presentation between 12 and 12:30. With that, I'm excited to welcome to the stage our President and Chief Executive Officer, James Verrier.
Good job, Pat. So good morning, everybody. So first of all, let me just echo what Pat said. It's really fabulous to see you all with us today. I know some of you have had a few travel challenges to get over and be with us this morning, but we really do appreciate it. As you can imagine, we've got a lot to share with you this morning. We're very excited about it. We think we've got a great story to tell this morning. And as Pat said, there'll be plenty of time during the day to get into the Q&A discussions that we want to have. So the one thing I want to say before I get into my deck is I want you to try and think of today as a progress report, if that makes sense. We shared a lot of data with you at the last Investor Day, and I'll recap that in a moment. I want you to get into the mode of how are these guys progressing? How are they a year on from the last time we all came together? So let me start with this chart that we've put together about 18 months, 2 years ago in BorgWarner. And I would say it doesn't look that much of a chart, right? It's a fairly simplistic chart, but this has become a very powerful chart for BorgWarner. And the reason that it's a powerful chart, it started to help us think differently a couple of 3 years ago inside the company. So let me explain that to you for a moment. There was a time where we were off in our little world doing these combustion products. We were making a lot of really good combustion products, and the world seemed to be over here somewhere. Everybody's talking about autonomous, rideshare, connected vehicles. Where's BorgWarner? Where do you play in this? And this chart really helps solidify it for us, that we see these as the 4 trends. We understand these 4 trends. Obviously, the green one there around fuel economy and efficiency is closest to our heart, but we absolutely had to understand these other trends to effectively run our business. So this is how we run our business. We think of these 4 trends all the time. They're the same as I showed you a year ago. The one notable difference I would say to you from a year ago is the connectivity between these trends has definitely merged. And you'll hear a little bit more about that from Chris and myself as we go through the day. So this was a powerful chart. The next one, we in BorgWarner at least believe that this was one of the most important things that we came to realize. So the notion is very simple. In our mind, whatever the vehicle type, whether it's a rideshare vehicle, whatever the level of autonomy is in the vehicle, whether the vehicle's connected or not connected, it is a vehicle. It is a vehicle, and its purpose is to move from A to B, as you saw in the video. And the only way in our knowledge that that vehicle can move from point A to point B is it needs a propulsion system. Without that propulsion system, it doesn't move. And that helped really define us as a company, or help re-clarify us as a company, that what we are is we're a propulsion company. And we're the leader in that space that drives solutions for our customers in all forms of propulsion. So let me take you back a year ago, actually. This is what we showed you at the last Investor Day. And this was how we tried to depict how our business would look in 2023. Okay, so what you see there, the blue and the orange and the green bar, combustion, hybrid, and electric. And what we were trying to do here is show you 2 key pieces of information. One is, what is our participation rate in those vehicle types? So the example there, in 2023, the target or the expectation for BorgWarner is we would have BorgWarner product on 42% of all hybrid light vehicles. 29 for electric, and you can see 53 for combustion. The other important notion for us was, what would be your content per vehicle, average content per vehicle on those vehicles? And you can see the numbers. And again, this was a 2023 projection. This also is very, very, very important for us, because what you see is we are agnostic. We're agnostic to the mix of propulsion vehicles. We're flexible, and we're not wholly reliant and counting on just combustion or just hybrid and electric. We will have a leadership place in any of the propulsion types of vehicles. So agnostic, balanced, and strong performance. That's kind of what it was about. So that sets the stage for what I talked to you about, or we talked to you about a year ago. What I think is important now is, how are you doing versus these 2023 targets? Where are you at? And that's kind of what I want to show you. And I think what you'll find is this is a really positive story. Before I talk about us, though, and our progress, let's talk a little bit about the industry and how the industry has evolved over the last year or so. So this is projections from 2016 to 2023, and we're using IHS data here, okay, just to be consistent, just like we did a year ago. So you can see it's calling for global light vehicle production growth of about 2% over that period of time. For what it's worth, on a BorgWarner perspective, our global growth rate's a little less than that when you average it out for our markets and our regions. And then you can see how it breaks down by combustion technology, or propulsion technology, I should say. So you see a modest decline in combustion. You see an acceleration in hybrids and electrics. So to put this in perspective from what you saw a year ago, you've added about 1 million units of pure EV by 2023. You've added about 3 million of hybrids by 2023, and you've come down about 3 million in combustion-powered vehicles. That's kind of the kind of frame. Not a surprise, right? I don't think anybody in this room would be surprised that the rate of electrification, the pace of electrification, has accelerated from a year ago. No real big surprise. We're aligned with this view, we agree with this view, and we feel very good about this view. And you're going to see why in a minute, because when hybrids accelerate and electrics accelerate, that becomes good news for BorgWarner. What I thought I would do, though, is in addition to showing you 2016 and 2023, is give you a snapshot of what 2020 looks like. And this is what you see. So what you see here is, I would describe it as a steady evolution. You're seeing a steady evolution. We're not seeing slow and then a big uptick. It's moving along gradually. As you can take hybrid as an example, in 2016, 3 million units of the fleet. It's 21 million by 2023, and you can see the data. We get to about halfway there at 2020. So not a big surprise here, but think steady evolution and not a rapid spike at the end, I think is the message for you. So that's the backdrop, and we understand this. Obviously, we work on this every day with our customers, talking about this evolution. We also know it can move and it can change and flex, and we're ready for that. So now let me get in and talk a little bit about how we plan not only to play, but to lead in combustion, hybrid, and electrics. I'll start with the biggest piece for the industry, which is combustion products. So you look at combustion products, and one of the things that's really interesting for us at BorgWarner is when we talk about combustion, we talk about growth. This is still a large part of our growth, and you'll see a lot of data from Ron and I during the day. So we love combustion because we still see significant growth, even in a declining market. Let's talk about how we're getting some of that growth. The products up here, for those of you that have followed BorgWarner for a long time, I think many are very familiar to you, right? Turbo, all-wheel drive systems, clutch plates, a lot of familiar things. Maybe one or two on there that are a little newer to you. Enhanced starters has only been on there for the last year or so with the acquisition of Remy. So it's an evolving combustion portfolio. One of the things that's really important, though, about our combustion portfolio, one thing ties all of these things together, and that is all of these products are very, very, very highly engineered products, as you know, and gives BorgWarner a very strong leadership position, which is super, super important when we're talking to our customers that are trying to advance and get next generation combustion technology in place. So let me talk about growth in combustion. So I want to ground everybody with this slide, and I'm going to take a moment to go through this. So this is the chart we showed you exactly a year ago. Okay, so I just want everybody to take a moment to absorb it. So we're showing here in 2016, 88 million combustion vehicles, BorgWarner participating in 44% of those vehicles at an average content per vehicle of $185. What we told you a year ago was in 2023, about 86 million, so you see a slight decline. But our participation rate has climbed to 53%. Average content per vehicle has also climbed to $215. So we got some feedback from all of you. Everybody kind of liked this. It was a good data set, gave people clarity. But 2023 is a little bit far out. So can you give us a sense of where you're at in the shorter term? So I'm going to show you 2020 data. Now, this becomes pretty important because if you think of 2020 data, this is getting pretty close to book business type numbers. It's only 3 years out. So what's the headline here? A couple of headlines. Our participation rate, we're projecting, will be at 50%. 50% by 2020. I would say that's just a little ahead of what we thought a year ago. So we feel we're a little bit further advanced. And I would say the content per vehicle, which is at $200 in 2020, is pretty much in line with what we were hoping for. But again, this is in a flat market. So what we're seeing here with our combustion story is a flat to slightly declining combustion vehicle market, and this adds up to a 5% CAGR for BorgWarner. So think flat market, slightly down market, 5% growth coming out of our combustion business. We like that. That's a very, very good, solid start for the company. Let me talk about where some of that growth is coming from with some of the awards. I'm not going to go through every detail on here, but what you see is a number of areas of growth all around the world. Turbo, we are particularly pleased with and strongly winning on small gasoline platforms around the world. Our variable cam timing business is growing globally and very strong. And our dual clutch business, as you can see, is really accelerating its growth in China, particularly. EGR modules also a very strong platform for growth. So good growth across the portfolio. Again, think back many, many years ago, it was a turbo story. Not anymore. You see growth across the whole combustion product line. Now let me talk a little bit about hybrid. And the growth in hybrid is really, really important. So one of the elements I always like to start with when I talk about hybrids, all of those products I just talked to you about in combustion in blue are all here with hybrids. None of the combustion portfolio goes away. It stays. And what we do is we add hybrid-specific technologies on top of those combustion products. I would even go a step further. From where we were a year ago, we are seeing more combustion products being added to hybrid vehicles than we saw a year ago. Turbocharger has probably been the lead example for us. The other thing that's really powerful about this chart when you talk about hybrid is look at the array of products. Look at the balance of products. This is not a one-product portfolio or a two-product portfolio. Very, very strong portfolio, and we really like this portfolio. Same setup as how we went through on combustion. So again, this is the data set from a year ago. So the hybrid vehicle market, about 3 million units in 2016, growing to 18 million in 2023. And you can see our participation rate was climbing from 20% to 42%, which is very strong. And our average content per vehicle equally strong, going from 140 to 225. So just like with combustion, let me give you a midterm report, a 2020 view. Everybody gets their notes. And here you go. So this is pretty powerful. So in that 11 million unit hybrid vehicle by 2020, our participation rate is already up to 36%. So slightly ahead, a little better than what we thought a year ago, really good. But look at the story on content per vehicle for us in 2020. We're already ahead of where we expected to be in 2023. So we have made massive progress in win rates around our hybrid technology. And we'll talk a little bit about some of that detail in a moment. But this is a really powerful story. And this is the proof for me that BorgWarner absolutely wins in a hybrid market. Absolutely wins. By using the combustion power products and adding the hybrid-specific technologies that I talked about earlier. Let me show you a sampling of some of these wins. This isn't all of the wins, obviously. This is just a sampling to give you a perspective of where we're covering the portfolio. So you see very good progress around our clutching technology and our disconnect technology in Asia. Very good. Our first exhaust heat recovery system in the US was a really powerful win for us. And one comment I want to make on hybrids and combustion and electric, everything I'm showing you are production orders. Production orders. I'm not talking development contracts. I'm talking real POs, orders from customers that will launch in these years. A couple more on hybrid that we're really excited about. Obviously, with the rise of 48-volt vehicle technology, we play in that space. eBooster is one of the best examples for us, where we combine our turbocharger know-how, our boosting know-how, our power electronics capability, and put all of that together in a system. Is driving real growth for us. You can see there are 3 programs already awarded for us in Europe with 48-volt eBooster technology. Very strong story. And again, to me, just reconfirms the strength and the depth and the balance of the portfolio globally and in many, many product lines. Now electrics. Let me talk about electrics. So one of the things I like the most about this slide, whenever I show this, and I show it quite a lot, is the broad array of products that we have in electric vehicles. And I think when a lot of people look at this, it surprises them, is the first reaction. You don't intuitively think of BorgWarner being able to fill a slide or 2 slides with technologies from pure electric vehicles. But let me tell you, we do, we have them, and we're getting wins with these products. So it's a pretty expansive area, It focuses on a couple of key areas, right? It focuses on electronics and power electronics. It focuses on thermal management also, and a broad perspective of electric vehicle products. So, again, same format, same slide. This is what we showed you a year ago. About 500,000 electric vehicles in play in the year 2016. Our participation rate small, 3%, with a high content per vehicle, because we're predominantly providing transmissions for those vehicles. And we projected out 2.3 million units, average content per vehicle of 285 for BorgWarner, at about 29%. Let me preempt the question of why is that content per vehicle going down? Well, because in 2016, we were really selling that one high dollar contented product across the vehicle. As we get out to 2023 and 2020, we're adding a much, much broader array of products, and that brings the average down. Let me put that into data for you. This is what we see in 2020, 2.2 million unit vehicle. So interestingly, the 2020 number for EVs is about what it was for 2023 a year ago. So that's where we see the pull forward and the acceleration, a little bit in pure EVs. The two metrics here, the content per vehicle, pretty much in line with where we thought we'd be. We're already kind of trending with that breadth of product to that 285 number. But we're really pleased with the participation rate. We expect it to be at 29% in 2023. We're already projecting to be at 26% in 2020. So ahead of the game on participation rates, which tells you we're getting more take and more wins across the portfolio on pure electrics. Really good story. What this translates to for us is about 100% revenue growth for BorgWarner. Remember the 5% I told you on combustion? It's about 90% on hybrids in a market growing at about 30%. And for pure electrics, 100% growth in a market that's growing around 30%. So we are gaining, we are winning with our technology. Let me highlight a few of our select awards here. Again, this is a sampling. The progress on e-gear drive transmissions has been very strong. Started out in Asia, is now coming to North America. Electric drive motor wins in North America. And then the electric drive module, I think, is one of the best examples of BorgWarner in an electric world. So what we do here is we take the former motor technology from Remy, we marry that up with the transmission know-how of BorgWarner, and we're going to be providing a fully integrated electric drive module system to no fewer than 4 customers in Asia and 1 in North America. And as we go further and we integrate the power electronics into that module and that unit with the help of our Sevcon acquisition, even stronger. All of what I've shown you so far on electrics obviously excludes Sevcon. That will only add to the story. That will only add to the growth for us. A couple more on electrics that we really like. Cabin air heating technology will be in our first launch this year, and we're building on that momentum. You can see 2 programs already sourced for us in Asia. Good story. And our auxiliary coolant pump is starting to get traction in Asia as well. So again, not just a broad array of products that I talked to at the beginning, we're winning. We're winning. Our win rates are strong. I'm very, very happy with the progress that we've made in electrics. Let me switch gears just for a moment and talk about our commercial vehicle business. So our commercial vehicle business, for those of you not that familiar, is about 11% of our company revenue. It's a growth business for us, which is wonderful after many of us have lived through the last 3 or 4 years of the down times in commercial vehicles, so we're happy to see a little bit of a rebound there. But the reason we really like our commercial vehicle business, in addition to the growth, we've got great technology, great products, we've got growth, we're very globally balanced, we have lovely balance across on-road and off-road, so it's a good, strong business for us. What we've done as we get into modeling the growth as we look forward today is we've assumed a very modest growth rate in commercial vehicle. We're not counting or planning on a major step up in recovery in commercial vehicle. But it is an important aspect of our business, complements our light vehicle well and drives growth for us. So now let me pause and take a moment to share this with you, because I think this is a pretty important slide. So this is now giving you a summary of bringing all of this together of how we see the business in 2020. And let's not forget, we're already halfway through 2017. So this isn't too far out. And this is book business type stuff, right? Okay? The first message and the most powerful message I want to deliver, look how agnostic it is in 2020. We are agnostic in 2020. If you actually want to look at it, we're slightly overweight to hybrid and electric. Now, for those of you that have been following us a long time, could you imagine me or any one of the team standing on the stage 5 years ago and telling you that we're going to be agnostic to slightly overweight on hybrids and electrics? And I'm looking around the room and there's a few people smiling and a few people nodding. This is a great progress and a great evolution for the company. And when I look at the participation rates as well, already up to 50%, every combustion vehicle that runs down the road, 1 in 2 is going to have product from BorgWarner on it. 36% of all hybrids will have BorgWarner products on it. 26% of all electrics. So when people say to me, I don't think you're really that relevant in electrics or hybrids, nothing could be further from the truth. A quarter of all electric vehicles going down the road will have BorgWarner products sitting on those vehicles. Very, very important. How we've got ourselves into this position, and Chris will talk a little bit more about this, is the way we engage with the customers. When we go talk to the customers, we talk about propulsion across the whole system. We talk to them about the trade-offs between electric propulsion technology, hybrid technology, and combustion technology. So we're in those discussions, and we can bring our technology forward to help in those discussions. So let me just try and close up here before I turn it over to Chris. I love the title of this slide, Staying Ahead of the Curve. You know, that's, for those of you, again, that have followed BorgWarner over its history, one of the things that we've always been able to do is kind of anticipate where the industry's moving towards and getting ourselves at the head of the curve. And to me, that's what we're doing again now. We saw that shift. We saw the shift in the evolution to more electrification, and we positioned ourselves to be agnostic in that evolution and move to electrification. And not only did we see that, we're acting on it, and you're seeing the results. And we're there, and we're ahead of where we thought we were going to be. So I said this on the call the other week. Yeah, I love this propulsion business. I love it. It's delivering strong growth for us. It's a balanced portfolio. It's a great portfolio. It's all driving to mid to high single-digit organic growth, balanced across the portfolio. And we're not staying where we are on margins, and Ron will share a little bit more on that. We're going to keep moving forward with that mid-teen incremental margin expectation. So we're going to deliver the growth. It's about a 7% CAGR that you see when you add up all the numbers, organic growth, and the mid-teen incremental. So hopefully, that's a lot of data we've thrown at you. We're thrilled with it. We're really thrilled. We like where we are in the journey on 2020, on our path to 2023. And with that, I'm going to pause and make us get to the next presentation. And I'm really, really pleased to have Chris come up and talk. Chris has one of the hardest jobs in BorgWarner, that he has to spend a lot of time and educate people like yourselves and me that we are the technology leader in propulsion. And a motor's not just a motor, and it's not. We are, and we're going to win in electrification. We're going to have the best portfolio of power electronics in the company, and that's what Chris is delivering for us. So with that, Chris, over to you. Thank you.
Well, great. Thanks, James. So as James said, I'm the Chief Technology Officer at BorgWarner, and I spend most of my time meeting with the heads of powertrain and the heads of strategy at the different automakers and talking about what's coming next. And so what I want to do today is really give you some of the insight that I gained from that and really get you excited about some of the products that we have. I'm going to show you a few, but we also have a few at the back of the room there as well. So James mentioned that we're winning all this business. So I want to talk about why we're winning the business. And the first of it is about customer engagements. It's a much higher level. I mentioned who I'm meeting with, but it's really at a strategic level, and it's really about this balance that we have between combustion, hybrid, and electric. And because we're agnostic and we have this balance, they tend to listen to me a lot more. Talk about product leadership a little bit. Product leadership it's something that's really ingrained in our culture. We've been doing this for over 125 years. Product leadership is about bringing the products to market at the right time. Inventors take money and go and create an idea, right? Innovators take an idea and go and create money. And we're in the business of innovating and taking products to market, and we do it in a mass volume. It's about getting the quality perfect. It's about getting the size to package in the engine bay. It's about getting all of the requirements from our customers right. And doing this in a high volume, time after time, is a core competency of BorgWarner. So let's talk about the challenges in the industry. When we look at the challenges, this chart is what's used at pretty much every conference I ever go to. And it's really showing the CO2 standards around the world, and it shows how they're all converging in essentially the same area. Now, when we talk about CO2, you need to realize CO2 is fuel economy. Okay? If you give me a CO2 number, I can tell you what the fuel economy is. If you give me a fuel economy, I can calculate the CO2. It's just a mathematical formula of a relationship. So when we're talking about CO2, it's all about fuel economy. You can see that these are all pretty much converging in the same area out in 2025. The standards for 2030 haven't been set yet, but we're having those discussions with regulators. Last year, I met with EPA, NHTSA, California Air Resource Board, the European Union, as well as the regulatory agencies in China. We have great insight into what's coming next. And I can guarantee you, the regulators are not stopping. That trend is going to continue going. So let's talk about these customer relationships and how it relates to that. Historically, BorgWarner would work with maybe the technology leading automakers. We would introduce a new technology with them, and it would be adopted by other automakers later. And it would take maybe 10 or 12 years to sweep across the industry. This is changing. What's happening now is, because of those standards are essentially converging at the same time, all of the automakers have to meet the standards at essentially the same time, independent of which market they participate in. And they're coming to us to have those discussions. The second part really is about being a balanced propulsion supplier and being agnostic. Because of this, I have discussions with them about what is the right portfolio. What are the right choices for them? And we actually go in and talk with the customers and say, this is what we think the best solution would be for you, or the most cost-effective solution for you, given your portfolio. So last year, let me just give you a quick story. Last year, I was at one automaker meeting with the head of powertrain strategy. And he basically stops the meeting and says, I have to go get my boss. So he goes and gets the head of strategy to have him come in and listen to BorgWarner's view of where their hybrid technology needed to be and which would be the most cost-effective solutions for them. So that's pretty powerful. And that's just one example of these types of discussions that we're having. The next chart, you've probably seen versions of this. It's been in our investor relations deck for many years. And usually we sit here and say, hey, our great customer diversity means that we're not really beholden to one customer. When I look at this, what I really see is it shows how many customers we're really working with around the world. What it doesn't really show is that there's actually over 100. This only shows all of the customers that have 1% of sales or more. But there's actually over 100 customers that we have, and that includes the traditional automakers as well as a lot of the new entrants that you hear about. So we're working with all of them, and this really gives us unparalleled insight into what's coming, because our engineers, our advanced engineering teams in the business units and at the corporate level are working with all of these guys around the world. So I mentioned product leadership and how it's part of the culture at BorgWarner. It's all about proprietary, high-tech, intellectual property. You know, each year we have over 200 patents, and I would class them as over 200 high-quality patents that really protect our intellectual property. Some companies are out there just getting patents to say they have a big number. I can tell you, putting patents out there costs money, and we really make that trade-off to make sure that it's really protecting our IP. I mentioned commercializing in high volume and bringing those innovations to market in high volume, and that's really difficult to do. And I'm going to talk about that with a few examples. Continuous innovation. Each year, even though we have a product in production, each year we're fighting for 1% increase in efficiency on the turbine of a turbocharger. We're fighting for small incremental improvements in efficiency in our electric motors. We're reducing the parasitic losses of our transfer cases. You go right down the list, this is what we do all the time. The chains we have in our timing drive systems get better and better every year. And the strong market position, which I think James already talked about. So let me talk about the turbocharger. This is one of our latest gasoline variable turbine geometry turbochargers. Turbochargers look like a really simple concept. You take the exhaust gas coming out of the engine, and you drive a turbine, which is connected to a shaft, which drives a compressor, which pushes more air in. What could be more simple? So the average turbocharger spins at about 250,000 RPM. We have some of them that spin up to 300,000 RPM. So to put that in perspective, it's 18 to 20 times that of a jet engine on the plane that some of you flew in on this morning. The temperature at the turbine side, which is on the left there, is basically running at 1,050 C, which is 1,950 degrees Fahrenheit. Yes, it's hotter than molten lava. The temperature at the other end of the turbocharger, you want to be as cool as possible to have the highest efficiency as possible. So this has to be more like 70 degrees or 25 degrees Celsius. It's a big challenge, and that we have to manage that thermal temperature across the whole device. The variable turbine geometry also has some vanes in the center there that are actually movable, and they have to actually operate in this very high temperature and ensure that they don't stick. So all of this has to be integrated into the engine system. And the engine system is not just the engine and you bolt this on. It has to work in unison. It's designed in early into the product, and we individually tune these for each engine. So deep systems integration. Oops. So let me talk about our eBooster. James mentioned it earlier. It's primarily being used on 48-volt mild hybrids. And this is being used in conjunction with a turbocharger. So it doesn't replace a turbocharger. This is incremental. And as James mentioned, it takes some of our turbo technology, and you can actually see the compressor on the right side of the picture. But the motor that we have this hooked up to goes from 0 to 75,000 RPM in 250 milliseconds. Okay? Think about that. As fast as I can click my fingers, it's gone from 0 to 75,000 RPM. Ostensibly, this looks like a glorified hairdryer, right? But the reality is, it blows a lot more air. A lot more air. The temperature that's generated inside the motor requires that we actually have to have water cooling. The architecture of this motor to do that transient, it has never been done before. So yeah, we had to go invent it. And when I mentioned before about invention, well, we did an invention, and then we innovated and put it in production. And this is now will be in high volume production. Again, this works with the existing turbocharger as well as the electrical system. So again, deep systems integration is required. So let me talk a little bit about electric motors. And specifically, I'm going to talk about hybrid and electric drive motors. Some motors out there are commodities, right? Whether it's the electric motor that moves your seat or the adjusts your mirror, they're kind of commodities, or winds the window up and down. They're automotive grade, but they're commodities. Let me be clear. These are not commodities. These are high-tech motors that really require high degrees of performance. And when we talk about performance in an electric motor, a drive motor, this affects the range of your vehicle. So if every incremental improvement we can make in efficiency means that electric vehicle can actually go further, or that plug-in hybrid can go further on the electric portion. The speed is about the same as a jet engine at 18,000 RPM. Actually, the circumference of this is quite a bit bigger than a turbocharger. And so actually the tip speed, it's not quite as fast as our turbos, but it's moving pretty fast at over 200 meters a second. Again, deep systems integration is required. It integrates with the power electronics. And when we talk about power electronics, it's really about getting the power electronics and the electric motor. You can make trade-offs, and you can make the power electronics better. You can make the motor actually perform better. And these are a system that comes together. When we talk about the topology or the different types of electric motors, there's a lot of them. And you can see that really a dominant design has not been established. There's a whole variety. Automakers are still sorting out which is the right one for the different types of hybrid architectures. And this depends on size, it depends on power, it depends on cost, depends on NVH, or noise, vibration, and harshness, how much noise they make. And all of these things are the trade-offs that they're making. What's key here is that BorgWarner has either been in production, is awarded production, or we've quoted and provided prototypes on all of these architectures. So we're a product leader in all of these different types of electric motors. So let me just get a little technical. And what I'd like to show you here is some innovations specifically with our S-wind high-efficiency stators, which is the stator is just the outer portion of the electric motor. So I'm going to start up in the upper right here. And you can see that the square wire that we use actually allows us to pack more copper into basically the same area as you would on the one on the left. And by packing more copper in, you can actually make the motor more efficient. So you can either make more power, or you can make the motor a little bit smaller. One of our unique innovations that we have, which is around not just design, but around the manufacturing innovations, is what we call our S-wind. And if you look at the picture on the lower right there, you can see that we have this very unique way of winding the copper as it comes out of the stator and goes back in. This S-wind, as you can see, versus the conventional, allows the motor to actually be smaller. It's actually, for the same power output, the motor's actually shorter in length, which makes it much easier to package in many of the architectures. The copper, because we actually don't have as much copper going up at the top and the bottom, that copper is essentially non-productive for making power in the motor. And so because you use less copper, the motor costs less to make. So this manufacturing innovation is really making the motor more cost-effective. If you take a look up here on the right, you can actually see some white between some of those copper strands. That's air, right? You can actually see through it. This really helps in heat rejection. So you can actually reject more heat and keep that stator at the right temperature, which again improves the efficiency. All of these little details that I'm talking about improve the efficiencies of electric motors, and because of that, increase the range of the electric vehicle. Oops. So let me just talk and summarize. You know, I've talked a little bit about some of the customer engagements. I've talked about the higher level of discussion that we're having and how we're really being viewed as a one-stop shop and how we're being brought in much earlier in the discussions and how we are really having this more strategic outlook with our customers. I talked a little bit about product leadership. We've been doing this for over 100 years, and it's not just in some of our products. This is the way BorgWarner operates, and this is the way we're pushing it across all of our products. So I'll just wrap up with, I've been the Chief Technology Officer for a little over 5 years now. And I have to say, the journey we've made in the last 5 years to get the portfolio where it is has been extraordinary. And the outlook we have and the view that I have says that we're extremely strong and we're going to have some great growth in the future. So with that, I'm going to hand it over to Pat, who's going to talk to you a little bit about the showcase as we take a break.
Thanks, Chris. So it's about 20 after now, so let's plan to come back here at approximately 5 of the hour, 5 of 11. So we're going to have 3 engineers available in the back, and just so you know who you're talking to, so we're going to have Paul Nara, who's going to be at our combustion booth. We're going to have Jeremy Barge, who is at our hybrid booth, and Joel McGuire, that's at our electric booth. And Christopher Thomas will be back there floating between the displays, so feel free to ask him questions on any of the technologies. And James, Ron, and I will also be available for questions during the break. So with that, we'll see you in about 30 minutes. There's still quite a few out there. All set? I'll wait for Pat to get back. You're good? Can everybody hear me? Okay, I'm going to get going here. They're still coming in. I'm going to wait a second. They're coming around the corner. All right, I'm going to start. I'd like to welcome everybody back from the break. And I hope everybody enjoyed the displays out there. I want to also thank our engineers that were out there with you, Paul, Jeremy, and Joel as well. I actually enjoy those presentations. We do them actually quite a bit. In fact, we actually do those for the board, just like you saw there. And I get a chance to actually walk with the board members and ask questions myself. I learn a lot every time I do that, and I go through the products with them. So I think it's a real good event for us to have. The engineers, you can ask them questions. So I trust you did, because I saw that it was very filled. Okay, my presentation is really going to center on 2 main points. And the first point is I'm going to talk about sales mix and then sales outlook. And then I'm going to switch and talk about how that sales mix and outlook, how we're going to generate financial returns. So those are the 2 most important things I'm going to talk about here. So this was our revenue mix in 2016. Remember, this is revenue mix. And based on the numbers James provided, we're going to take a look at what 2020 looks like.
as you can see, we're basically in lockstep with the industry. As James also mentioned, we're outpacing the hybrid and electric markets and growing much faster in those markets, and he gave some numbers around that. But I think the more important part about this slide right here is that we still outpace the combustion market. I think he gave a 5% CAGR in that market. Basically, in a flat market, we still see tremendous opportunities in combustion. I'm going to go through 4 samples of market opportunities and give you details. Remember, these are opportunities. But the most important part, the magnitude of these opportunities are really important to us and are significant in numbers. And first, I'm going to talk about the combustion dual clutch module market opportunity. I'm going to take a point in time. 2023, the combustion market's expected to be 83 million vehicles. Dual clutch penetration is 12%. With our market share of 38, the average content is $300. That'll be a $1.1 billion product line for us. Today, we currently do about 300 to 400 million. So that opportunity alone is $700 million incremental opportunity. I'm going to look at 2 hybrid applications. First is hybrid boosting. Now, the hybrid market is expected to be 21 million units in 2023. You can see the market turbocharger penetration number, our market share, and the average content of $250 generates another $700 million of opportunity. But more important, this is in the hybrid space. We know that penetration rates in the combustion space are going to continue. This is just in the hybrid space. Another hybrid application is the P2 hybrid market opportunity. Again, 21 million vehicles. Now, this configuration is a very popular configuration for the OEMs. And the reason is it fits really nice into the drivetrain. And it'll give them a lot of benefits if they adopted P2 architecture. You can see that we estimate 55% market participation by BorgWarner, which is a very high number. But I'm going to explain why that's a high number. You take a look at the content per vehicle and look at the smaller items underneath. Our content can range from just friction plates, transmission control modules, to the entire module. And we are really in a unique position, unlike other suppliers, that we came from the clutching base as a company many years ago, and then we started adopted the electrification. There's not many suppliers that can provide this whole content on this module, P2 module, than BorgWarner. So therefore, we're real confident we can have 55% participation. But again, if you take an average, say $230, that's about a $350 million opportunity for us. We'll talk about electrics for a second here. Electric drive motors and modules. You can see the 2023 market of 3.5 million vehicles. Obviously, they're 100% penetration. But more importantly, this assumption assumes that 40 to 50% is outsourced. Or, when we're looking at it, the OEMs are going to insource 50% of it. That's not in a lot of people's minds about what the OEMs are going to do when it comes to electric drive motors. We know some are going to insource. We also know some are going to outsource. So our assumption is about 50% insource. You can see our estimated market share of 15 to 20%, and the average content gives us a 200 to 350 million market opportunity. Really, the growth of this is beyond the 2023 as the market evolves. It's in an infant market at this point. Also, I'd like to point out, when you get into electric drive motors, I think Chris was talking about, there's components that we provide could also go to the OEMs. So they may not, they may assemble the drive motor themselves, but buy the stator from us. So there's other, I guess, variants of products that can be provided by BorgWarner in this space. Okay, if you just added those 4 samples I gave you, that's $2 billion of market opportunity. And that doesn't even count other significant opportunities that we still have in combustion, hybrid, and electric space. For example, PT heaters in electric space, variable cam timing in the combustion space. So that's $2 billion. That's a tremendous amount of opportunity that we see going. Now, I'm going to switch gears here a little bit, and this is probably the most important slide I'm going to show anybody today, and I would say the most important slide today, okay? Okay, because I'm going to show you our revenue outlook for 2020. First, I'm going to start with combustion. You can see about $1.7 billion of additional sales, but more importantly, the CAGR is 5%. This is in the flat market. In hybrid, you can see our CAGR, which, as James mentioned, outpaces the market. So we're well in excess growth of the market in hybrid, and we see the same thing in electrics. We're outpacing the market. Now, I have to add on our commercial vehicle market and aftermarket sales growth. The majority of that CAGR really is this year. We actually anticipate it goes back to about 1% growth. And then I'm going to show you what it looks like in 2020. Basically $2.7 million, and that's a 7% CAGR. And that did not include all the opportunities I just went through, that $2 billion. Now, the $2 billion was on a 2023, but obviously that's going to flow through. So this is our 2020 outlook as we go forward here. Now, I'm going to switch gears. The first part, I just talked about our product mix and our revenue outlook I just gave you for 2020. Now I'm going to switch gears and talk about financial returns, because we often get questions about our financial returns in a propulsion systems that are changing to hybrid and electric. And a lot of people are concerned about what the margins are going to do, and can we sustain margins, and can we get our returns. So I'm going to talk about that. So our 2016 operating margin adjusted was 12.6%. We still target mid-teens incremental margins. So if you do the math, by 2020, we'll be in the low 13% operating margin range. Now, so why are we so confident about our incremental margins? We get that question quite a bit as well. The first thing is incremental margins and return on invested capital has been ingrained in our organization since the late 90s. We actually have a variant of it we call economic value. Our incentive plans, quite frankly, are based on generating economic value, already down to the shop floor. I won't go into a lot of details, but shop floor people, 50% of their incentives are based on generating economic value, positive economic value. Each decision or each project that we approve has to stand on its own merits. So if that's a combustion or a hybrid or electric, it's got to generate a return I'm going to talk about in a second. We have very good governance around investments. You can see the numbers here of who approves investments. What's not on that list is we do a post-review, completion review as well of all our major programs to see how we did. Did we generate the expected returns that the appropriation request for that capital requested? And then generally we do a very good job. And then the most important part is that every program, no matter what it is, combustion, hybrid, or electric, has to generate, a minimum of 15% after-tax return on invested capital, or else it does not get signed. Okay, so another question we get, and I'm going to say this is the second most important slide I'm going to show you today, is how are we doing on returns in hybrid and electric? And we struggled for some time. How can we communicate this to you? And how can we demonstrate our returns in that space? And we came up with this slide. On the bottom is the start of year production for the program that we've been awarded. On the y-axis is the return on invested capital. Combustion first. No surprise. The returns are 18 for the most part. All the programs that we've selected are various, their variety in products, customers, and region. So we took a cross-section. So the next one is hybrid. Note how similar it is. Very similar to what looks like combustion. The next one is going to surprise some people, but it doesn't surprise me or James because we sign off on these projects. You can see they're in the same range. So therefore, we're very confident we can continue to get our incremental margins and our return on invested capital as the propulsion mix starts to change for BorgWarner. Now I'm going to switch gears a little bit and talk about capital allocation. Basically, because of all the revenue we had and the returns, we're going to generate significant cash flow. And we're going to maintain a very investor-friendly balance between investing in the company, growing the dividend in line with our cash flow, pursuing strategic M&A activity, and then offsetting the stock-based dilution effect from compensation by doing share repurchases. So we feel this is a very balanced approach going forward, and we're real comfortable that in the end, it satisfies everybody's need for capital allocation. So this is my summary slide here. Remember when I started the conversation, I said I'm going to talk about two things. The first one was the revenue mix and the revenue outlook. Then it was the financial returns. So on the revenue perspective, we just showed you a 7% CAGR by 2020. Our mix is lining up with the industry. And then on top of all that, I showed you just 4 examples of opportunities that are not in our numbers that shows you how much growth potential we have. Then I switched gears and showed you that we're comfortable at incremental margins. We'll start to expand from this place where we're at today, despite the evolving mix that we're seeing in propulsion. Our hurdle rates will be basically there. And then we're going to have a very balanced capital allocation with the cash that we generate. So I got one more piece of information I want to give you. I've been doing this, I've had this position now, I'm going on my 6th year as CFO. I've been with the company quite a while. And I'm going to say something on the back of what actually Chris said. It is truly remarkable what we've done as a company with our portfolio management over the last several years, 3 years, and how we basically pivot the organization to address the trends that James talked about when he started. It is truly remarkable. What's even more remarkable as the CFO is during that transition period, our ability to maintain margins, and I showed you what we're doing on this, in the hybrid and electrification space. Under my watch, things are not going to change. So as far as being confident in what we just showed you today, the growth, the portfolio that we're at, and the financial returns that we're going to get is going to be what BorgWarner is, quite frankly, known for in the past, and is going to continue to do that in the future. So with that, I want to thank everybody for your attendance, and I believe with that, James, you come back and gives us a little of a wrap-up, right?
So the CFO always thinks he's got the best slide. That's it. What else did we, yeah. So we were talking about kind of how to wrap this all up. So this is what we're going to do. I'm going to summarize the select customer awards that we've been booking over the last few years. Because one of the things I learned about 2 or 3 years ago when we were going through this transition and this pivot, a lot of you in this room gave me some really good feedback. At the end of the day, James, it only matters when you get some POs and you can show me that real bookings of business. Ultimately, that's what matters, right? All the other stuff is interesting and we can have great PowerPoint, but unless you're booking and you're winning, it doesn't really matter. And by the way, just so you know, that's kind of how we run the company every day and every week. So this is just a sampling of what we've booked in combustion. And I'm not going to go through every one of them. But what it really reinforces, again, to kind of bring this to closure, is look at the breadth. Look at the breadth of products. Look at the breadth globally. And you don't do that unless you're a real leading type of a company. So again, go back a few years and it was turbo, 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 and a little bit of DCT, no more. This is the balance that we've got in combustion. These are some of the select awards that we've done in hybrids. So Ron talked a lot about P2 modules. You can see that's there. Can also talk about commercial vehicle P2 as well, by the way, which is interesting. And again, I won't go through all of them, but this is a broad range of bookings. And obviously the numbers you see in brackets there are SOP dates. So these are booked, contracted awards with customers that are launching on the dates that you see here. No surprise with the next chart. I actually think this is the longest list, by the way, of the three, and that's a reflection of where we're winning. So I mentioned earlier in my presentation, very strong position around our e-gear drive transmission technology. Look at the wins there, look at the bookings. 2 launches in 17, 3 in 18. Electric drive modules in Asia, launch. Cabin heaters we launched this year in North America. We follow that on with following launches in China a couple of years later. So again, the evidence for us is there. We're engaged with our customers across the whole spectrum, combustion, hybrid, electric, and we're winning, and we're booking business, and that's what's driving the growth. So I'm just going to conclude with this slide before we get into Q&A. You know, we made a very intentional shift in our strategy 3-4 years or so ago to get ourselves balanced around combustion, hybrid, and electric. And I'm just going to tell a real little quick story, like a bit of a secret story inside the company. I may have shared this with a couple of you before. It's about now that Pat starts to look really worried. He doesn't need to look worried. We used to have a lot of debate inside of BorgWarner 4 years ago of what is the mix going to be around hybrid and electric. In fact, we didn't have a lot of debate about hybrid. It was all about electric. It was all about, is electric going to be strong? Is it going to be weak? Where's electric? And there was a pretty famous meeting inside the company 4 years ago. I said, I don't care anymore. That conversation is dead. It's over. We're not going to talk about it. The only thing we're going to talk about in these meetings again is what is our product lineup for pure electric vehicles and what is our product lineup for hybrids that can get us in an agnostic position and drive mid to high single-digit organic growth. I don't want anybody to talk about it anymore. I didn't realize at the time how powerful that was because it changed the whole narrative inside the company and everything shifted and pivoted towards building a portfolio that was agnostic for combustion, hybrid, and electric, and that's the result that we're seeing right now. I think as Ron said, I would echo something Ron said, not only during this period that we've been investing for hybrid and electric technology, and we've been growing the company, we've been expanding margins. And we feel very proud about that, and there's no reason that they stop now. They can continue going. And all of this comes down to one really, really fundamental thing that Chris mentioned, and I just want to stress it again. We can't do any of this without the customer relationships that we have. We can't. So we are very, very entrenched deep with all of our global customers, not only to understand where the future is heading, as Chris alluded to, but making sure our product portfolio wraps and matches what they're looking to do. So this is my 28th year with the company, and it's a great company. I love this company. It's just a great place to be. And I would say we're in a really, really good spot. I feel very good where the company's at, both in the current near term, as we demonstrated over the last couple of quarters again, but as importantly, where we're heading for the future. I've never felt better about engagement with the customers, clear strategy, and a set of bookings and win rates that support the growth that we're communicating today. So with that, I'm going to pause. I'm going to turn it over to Pat so we can get into the Q&A portion, because I know many of you have got a lot of questions for us. Thank you. Pat. Just give us a minute. We can do this, Chaz, shall we? You want us up?
Yeah.
All right. Ooh. Thank you.
Okay, we're going to open it up for Q&A. Probably have about 45 minutes to an hour. So with that, I'll take the first one. Start with David here on the right.
Great, thank you. It's been great watching the company over the last 23 years you've been public. And how the tech companies evolved, the technologies evolved, cars have evolved, and you've always found a way to stay in the mix. And as we're going forward here, this portfolio, puts you in that mix as well. What I'd like to have you embellish on a little bit, if you could, is if we talk about new automakers coming into the space, new entrants into the space. There's a way you could address how you participate with those, whether they're OEMs becoming electric vehicle companies or EV-focused companies, shared mobility companies, what your role is there, and if there's a way to talk at all about how you've quoting business or any business wins along with those customers.
Sure. So yeah, first of all, just to echo David's thoughts there, we have evolved. We've always found a way to evolve, and I think we're evolving right now. If you look at the new entrants, we're very active there, frankly speaking, and whether that's everything from startup companies in China to electric vehicle manufacturers here in the United States and other more speculative type newcomers to the space, we're very much engaged, and I would say very openly, a few of those sought us out, because as they came into the space, they were trying to figure out what are the options here around propulsion. What are our options? Is it purely an EV play? Is there a hybrid play? How does that work? What's the linkage between autonomous? What's the link? So I would say we've engaged, I'm not going to name all of them, but I would tell you pretty much all of the new automakers that you're familiar with, we've had some level of engagement and conversation and discussions with. The one thing I would say specifically, David, about bookings, with all of our customers, we follow their lead in announcing product wins, and they're very particular, which we respect, about the timing of those announcements. And so we're very careful about not getting ahead of our customer in announcing some of those wins in electrics particularly, but very actively involved, both proactively and through bookings of business that you'll see show up in the next couple of years.
Yeah, and maybe just to add, a lot of those new entrants are not really focused on the propulsion system. They're focused on the in-vehicle experience and how big the TVs are in the back seat and all of the other experience of the vehicle. And they just want someone to take care of the propulsion system for them. And they, we have a lot of discussions with them on that.
Why don't we go Rod up here?
Thanks. Wanted to ask you about the this electric vehicle penetration number that you put out for 2020, that you'd be on 26% of all the EVs that are out there in the market in that time frame. In that time frame, it seems like the early adopters are going to be disproportionately Chinese. A lot of the EVs that are coming out in the near term are in that market. Could you just talk a little bit about how what differences there are? I imagine that market share is heavily influenced by these Chinese electric vehicles that are coming in. What are the differences when you're talking to Chinese OEMs versus the Western OEMs? Do you think that your penetration rates will be similar when you start to go out with more established and larger global automakers?
Yeah, that's a good thought, Rod. I would say in general, you're right, the activity level on pure electrics has been really, really pretty heavy in the last 2-3 years with the Chinese guys, for sure. Certainly ahead of some of the Western companies. I would go back to something Chris said a moment ago. What we find in general, is with the Chinese OEMs, there's a willingness to probably give us more influence and more freedom in the architecture and the design of the propulsion system. Many of them are not steeped in decades and decades of history as some of the traditional European-based OEMs. So they lean on us pretty heavily. And that's why you see the win rates with the electric drive module where we're literally providing the whole propulsion system. And they're very, very supportive of us doing that. So they give us a massive chunk of that propulsion system, and we're doing that for them. I would say that's less that way in Europe and North America. It's a little more they're owning a little more of the system, and then leveraging people like us to help optimize that system. And we may be providing the motor, we may be providing the transmission, we may be providing componentry. So that's how we've seen it thus far. I think there's a little more latitude, flexibility, and ownership for us with the Chinese OEMs than European and North American-based OEMs. But the interesting thing that's in parallel is the conversation around the configuration of what the propulsion system looks like. We're actively involved in a similar way. It's just then the OEMs in Europe and North America probably take over a little more of the system control and content. So that's how it's evolved so far, if that helps you out, Ryan.
We go to Brian in the middle.
Yeah. Brian?
Fourth row right there.
Wave your hand, Brian. Wave your hand.
Sounds a little slow.
Because they don't know.
So 2 questions. One, I want to follow up on that China point. But before that, about a year and 4 or 5 months ago, you took a dramatic haircut to the backlog, I think stung by some of the program delays in calendar year 2015. Can you maybe bring us up to date as we think about the backlog that's been rolling on this year, that's rolling on next year, kind of how much conservatism had been baked into that backlog as you risk adjusted the launches? What's your visibility now is on that, and then how it makes you kind of feel about the rest of the year as well as the 2018, 2019 backlog?
Yeah, let me start, and then I'll let Ron put a little bit of detail and data around it. So yeah, we remember it well, by the way, the haircut. The haircut, the reset button somebody mentioned earlier. Yeah, we remember those days and prefer to look forward to it. You know, what we did there was, I think we took a more prudent approach where, if you remember, we still had all the base roll-up detail numbers to support all of the launches and the activity. And then we did two factors we applied. One was there's probably going to be some macro noise, so better load that in. And then I think we took a little bit more of a prudent reductions or adjustments to both the launch ramp-up curves and the timing and the volume. So that's what we did. As painful as that day was, it was a good strategy for us, because I think ever since then, we've been comfortably hitting our backlog numbers as we went through last year. We delivered on our backlog. We actually exceeded our backlog last year, and we felt really good, because I think that confirmed that the methodology worked, or the shift in methodology. As you get into this year, Brian, you know, we've had 2 really strong quarters, and we're above where we thought we'd be coming into the year on the backlog. So again, good story. This year's backlog is a little more less major program focus. There's a lot more programs, but so far, first couple of quarters have really played out well for us. I'll let Ron talk about what specific numbers we're assuming into the second half. But the one thing that I think is important is, as people look forward and look out, you know, how do you put this year into context as you start to think about future years? The way I would think about it, and I think you see that in our numbers today, is you should think about the years ahead on a similar run rate to the whole of this year. Don't get too caught up in 13% in Q1, 8% or thereabouts in Q2, 4 or 5% in the back, whatever. There's movement in there, and it's explained by different timing of events. I would look at the year in whole, the year in whole on our latest guide, and that's probably a pretty good reference point. And if I bridge from there, if you think of where we are for our guide this year, for this year, and then you look at what Ron's just outlined for the next 3 years, that 7% organic CAGR, that lines up pretty well. So, but if you want to add.
Yeah, I'm going to add a little bit more numbers to it. So, in the process, after the reset, the fundamental difference is that we took a look at what the operating units provided us and made judgments. That's the only thing that changed. The actual fundamental process of our operating units generating their book business and then presenting that information to James and I and the executive management team has not changed. And it's not going to change going forward. In fact, they're actually doing it on a quarterly basis now. So now we get a better look of bookings and we'll call it our backlog numbers, or we call it our long-range plan, every single quarter. So that's one change we actually did tweak this year, is to make sure that we're on cadence for bookings. We're tracking our bookings much more closely every single quarter. So that fundamentally hasn't changed. What we did do when we did the reset, we took a look at specific programs, and I'll give you an example for 17. The dual clutch launches that we're seeing in China, we backed off those rates for various reasons. One reason is because it's a China market, but more, were they really capable of hitting those volume numbers in their launches? We know that eventually they're going to get there. The only question is when they're going to get there. So we backed off those numbers. And actually it worked this year, because what happened was we did have some headwinds. We all know the diesel gas mix in Europe has been a headwind, but we got a tailwind from commercial vehicle. And then we also had a tailwind from the dual clutch launch. So it was puts and takes through the year, but net what happened, we ended up way on the high end of our backlog launch this year, right? So next year, Brian, we're going to keep the same process. We're reviewing our backlogs. We're going to take a look at significant programs and make a determination if the volumes are realistic. Some of you use the word conservative. I don't use that word. It's more of a prudent approach to take a realistic look based on our experiences and our history on given regions of the world and where we have to risk adjust the backlog. And that's what we're doing, and we'll continue to do that process going forward.
Second question, following up on China. If you think of the China EV or China OEMs as three buckets and how they might, who they are and therefore what they're doing in EVs, sort of the Chinese local companies who don't have JV partners, the Chinese locals who have JV partners but are doing EVs outside of those alliances, and then the partnerships and doing Chinese branded but still partner JV'd EVs. A couple things. One, how do you see those three sets of players and brands evolving in the EV market? And then two, where are you getting the traction, and what happens when the EV JV things take off? Is that a headwind to your participation?
Yeah, no, I would say in general, Brian, we are engaged with all of them, or all of the different groups, if you wish, that you'd articulated with. So we're working with, with all of them. I would say they're all moving pretty aggressively, actually, around their EV propulsion technology, and we're engaged. And you saw that in some of the numbers. I think the e-gear drive transmission was 4 or 5 programs, Pat, in Asia. So we're winning. And I would say, in general, Brian, we're winning with both the local Chinese domestics and with the JV partners from Western partners, if that makes sense. So we're not with only one group or either. We work with both. And I would say, importantly, that's not just EVs, that's hybrids also. I would say it's both configurations we see that.
So we'll go Colin in the 5th row over there.
They don't know who Colin is.
Thanks for taking my question. You were talking earlier, Chris in particular, you mentioned that you talked to a lot of different OEMs about the programs and have pretty good line of sight. There's some pretty bullish announcements around EVs, so the 3% forecast by 2023 might be perceived as low. I mean, I guess sort of 2 parts. I mean, are you seeing 3%? Is that from your line of sight, or might it be some upside to that? And there's also talk on the other side that internal combustion engine programs are actually coming down a lot, that we're not going to see a lot of new engines. Are you seeing that as well? And then when I look at the slide up there, I mean, your participation is pretty low. So what is the risks that we should be thinking about if it's above 3% for Borg overall?
Yeah, so let me tackle the first one. That is really about the EV penetration. Yes, the automakers are making announcements, and those announcements. I think if you look historically, they've been a bit more bullish than what reality has proven. But when I talk to them, they're really talking about programs and sort of volumes that are realistic. And I think the numbers that we're showing really tie to what we're the discussions that we're having at high levels in the organizations. I think also the press tends to maybe misquote some things. One automaker said that they'll have electrified powertrains, and then they're being quoted as being all EV. And that's not what they said. They said to be electrified, which means may well be hybrids in there as well. In fact, some of the automakers are also including mild hybrids, but some of them are including stop-start, saying that's in there as well. So you have to really dig into some of the details. Yeah. On ICE, there's still a lot of work ongoing on internal combustion engines, and it's the next generation of internal combustion engines that are really being worked on heavily to get that diesel type efficiency. You'll hear things like millicycle or dedicated EGR, and which require advances in valve train and turbocharging to be able to enable these. So we see a lot of activity there.
The only, Chris is right on. I think a couple of additional thoughts, Colin. One is back to the whole premise here is 3% could be light, it could be 5, it could be 7. That's okay, we win. That's important. We're not worried too much. And I get your point, the 26% looks a little low. We're pretty thrilled. It's only about 3 or 4%, and 5 years ago it was like 0, kind of. So we're 26 we feel is a pretty good number, and when I look at the win rates, we feel pretty good. Your other question, though, is what should we be concerned about in there? These are all awarded programs. So really the only variable now to think about, Colin, is do these programs launch on time and with the right, the volumes that we've assumed in here? I think it's fair to say on electrics, we're going to be pretty prudent on our assumptions there, knowing that there's a lot of speculation and volatility, what could happen.
Why don't we go with Joe in the fourth row here?
It's there. Oh, Joe's back. We have half an hour yet.
Thanks. Maybe just a quick follow-up on your comment about what people are including as electrified. In your hybrid assumption, $240 of content, it sounds like you're using IHS, which I believe is first has sort of the 48 volt transition. So if that mix of hybrid proves to be more towards plugins, does that content go higher, or is that an average content across all your different types of hybrids?
Yeah, the 240 is our number, right? So that's our average content per vehicle. So that's our number, not an IHS number.
Okay.
And we're including everything in there. That hybrid bucket, we stop-start, we put over into combustion, and then electric is pure battery electric vehicle or fuel cell vehicle. And all hybrid architectures, whether they're 48 volt, 12 volt, P1s, P2, P0s, all of that, that's all lumped in the orange bucket. What drives it more, Joe, is what content do we get? Ron gave a couple of really good examples on that P2 architecture. We could be anywhere from $35 of content with a clutch plate, or we could provide the whole, clutch and motor configuration, which is pushing $1,000. It'll vary more there, is what I would say. But Chris, maybe you could talk about 48 volt a little bit. Your thoughts on that?
Yeah, well, 48 volts, obviously the BAS system, the belt alternator starter systems are going to be essential for that. Power electronics integrated into it, the eBooster, and when you look at it from an automaker's perspective, they can integrate these products into it in essentially existing architectures, and they can do this on more vehicles very quickly, and they can do this from a fleet average. They can get the same fleet fuel economy numbers by doing this on more vehicles quicker. And so I think you're seeing that that's maybe a more cost-effective way for the automakers to move into hybrids. And that's why 48 volts is growing as fast as it is, because of that the benefit you get.
And then, Chris, you provided some good information, technical information on motors, and Ron, you had some good information on the outsourcing element as well. I guess I just want to understand how you think about some of the existing industrial motor players where, they're clearly not auto grade today, but they know how to make motors. And I think you could argue they haven't really been focused there because the volume hasn't been there yet. But if this conversation today is correct, the volume is coming. So, how long do you think it could take them to start to get interested, or are you already seeing them getting interested? How long to get to auto grade, and what's your competitive advantage, versus those guys if they choose to enter the market?
Yeah, I give it the way we think about it now, Joe, and things will evolve. But our view on the drive motor is there will probably be 5 or 6 key players, excluding the insourcing. Insourcing's its whole different animal, but we think it'll probably be 5 or 6, maybe 7 at the most. We think because of the technology that's required, and this technology continues to advance, we think the majority of that group of 6 or 7 are likely to come, that are already there, and they're just going to evolve. You may get 1 or 2 come in, but we're not looking at 10 or 12 guys being able to provide drive motors. But we also don't think it's going to be 1 or 2 either. I think it's going to be 5 or 6 or 7. And if you think about it for a moment, that's kind of what we do, right? When you look at the turbo space today, there's 5, 6 guys in the turbo space. You look at EGR products, 5 or 6 guys in the space. You look at clutching materials, 4 or 5 guys. So could you get 1 or 2 more in the motor space versus some of our combustion products? Maybe, but I don't see it proliferating that there's 10 or 12 of these guys, Joe. We'll see over time. But the more I learn and understand this from Chris and others, the differentiation in the technology here is going to be a big challenge for guys that want to come in and play in that space, together with the capital intensity that I think it's required. So we keep our eye on it, but we feel pretty good. It's going to be somewhat similar to the combustion and the hybrid type space.
Do Rich Quass in the 6th row back there.
Yeah, that's okay. You should take one in a minute.
Thanks. Good morning, everyone. Just a couple questions. Just back on Brian's question around China and the backlog. A couple of years ago, the bigger part of the issue around backlog forecasting was China. And as you look to, you made some changes around how you put this together across globally speaking. I guess, how do we think about what's happened in China as it relates to, has the volatility lessened? Has there been a meaningful change in your mix of customers or vehicle mix? Because I know a couple of years ago there was some issues around vehicle mix and customer mix. How would you characterize the potential volatility going forward? How comfortable you are with China right now?
Yeah, I would say, Rich, first start off from an industry perspective. We're in the view that China's a 1 or 2% type growth market for light vehicle, where you may get some cyclicality and some noise in there, a little bit of volatility, but generally we're planning on a 1 or 2% growth environment for light vehicle. I think if you look at it, compare it to say 5 years ago, it's less volatile. There's still probably incrementally more volatility than Europe, but it's not bad. For our business, though, what's changed in the last 2 or 3 years? I think pretty meaningfully, there's a couple of key moves for us. One, our outgrowth of the market is very strong, double-digit outgrowth versus the market. So it makes us a little less market dependent. So that's a change. But I also look at our product and customer mix. Many of you would remember 3 or 4 years ago, our dependence on the Volkswagen Group was very high. And as we've grown with more and more customers out there, particularly the Chinese domestics, we've now got a really nice balance. We're pretty close to 50-50, China domestics and global. And then the other thing that's changed over the last couple of years, Rich, to give us more comfort, is our product diversity has grown significantly. So again, go back 3-4 years ago, it was very much a turbo-weighted story. Now we've got DCT has really ramped, so we're getting the benefit of DCT. Our EGR plant is running very strongly. Our variable cam timing business is very strong. So you put all of that together, and it's just a much more manageable, frankly, situation, and we have a lot more confidence and comfort in it than maybe 2, 3, 4 years ago.
Okay, all right, that's really helpful. And just a question for Chris around engine variants on the ICE side. So it seems like some automakers are changing the amount of variance they have on the engine front? And, how do we think about that for BorgWarner over the next 5-7 years? If they're curtailing some of the options and the variance there, is that neutral? Is that a net positive, net negative? I know there's a lot of moving parts there, but just if you were to say like what BMW said a few weeks ago around changing some of the variance, curtailing some of those, how should we think about that?
So I don't think it's something that's new or different. This is something the industry, the powertrain of the industry has been doing for many years. They've been consolidating the number of engine families and making more and more commonalities. They've been taking the same power cylinder, that's the piston, and connecting and using it on 3 cylinders, 4 cylinders, and 6-cylinder engines. And I think we're just seeing more and more of that. So the internal combustion engines are becoming maybe bigger platforms, and the implication is that you still just want to win that business, and we are. So I don't know if you want to.
Yeah, I would say probably neutral, Rich. I think there's examples where I could point to where they've gone, more global engine platforms, around the world that have played well for us. Our global manufacturing footprint plays well for us. So I would say neutral, maybe a slight positive for us, but not a big shift for us.
Why don't we do Jim in the middle over there, and then we'll do Emmanuel up front.
Good.
Thank you. I had a follow-up on Colin's question, but it ties into the profitability and the returns on capital. You've got great visibility out to 2020. All those contracts have been awarded. But I use you as an example when I talk to probably one of these 6 competitors of yours about the incrementals and their margin outlook in 3 to 5 years. And their pushback was, yeah, our OEMs know about the incrementals too. And on the 3 to 5 year outlook, their profit margins, the OEMs, are a lot less visible than necessarily the suppliers. And so their argument, counter to me on improving margins on the incrementals, was they're having to start giving that away in the 3 to 4 year contract awards. And they said, do not expect to see margin improvement. And this is like a 10% margin company, so they're pretty well positioned. Yeah. And part of it was it could be greater R&D burden. There's a lot of ways the OEMs can put pressure back on the suppliers. Nothing new. But I really wanted to get your thoughts on that, because 6 or 7 players with a lot of 10, 15% market share positions all going for this business. There's a lot different dynamic than the dominant position that you and one other have in turbochargers. Again, it was just some pushback on my argument that I was using you, in terms of margin improvement. And it really ties into the hybrid and electric vehicle side of your growth profile.
Yeah, no, it's fair, Jim. Ron put up the data, you're right, of how we're doing, right now over the next 3 or 4 years, and it's healthy. I would say Ron and I also are constantly signing off on programs that are not even launched until, 2021, 2022. And those are 5-7 year programs. So we've got visibility through 2023, 2025, and we're not seeing that margin erosion or degradation, actually. We're not. And I don't know, I can't comment on the others. The only thing I would just reinforce is, the base assumption here is, 5 or 6 competitors, just like we have on combustion, and strong technology differentiation. And I think all that time that stays in place, we're gonna be fine. We know how to operate. We know how to drive the growth through the bottom line. We know how to do that. So is it a risk? Absolutely, Jim. I wouldn't blow it off at all. But we're not seeing it in our numbers.
I'd just like to add something. I can't speak for other companies, but I can tell you one thing. Culturally, inside this organization, we're not going to accept that argument and just lay down and say, well, you can't get there. It's not us. I know what contribution margins are. I understand that very well. Cost structure. I've been in manufacturing all my life. I can have a different discussion when we get into cost structures. And that, on top of a lot of techniques we have inside the organization designed for value and taking cost out, in combination with the business that we were awarded, doesn't lend itself to say that we should be deteriorating our margins. And it's just not acceptable culturally inside the organization. So if you keep the culture, it's not acceptable, they're going to find ways to get cost out and deliver it. If you lay down and and you accept that that's going to happen to you, you're right. You're going to have your own destiny there. But it's not, at my helm, it's not acceptable. Okay?
Yeah. I just want to, so not to overdo this, but I think it's an important perspective. So when we go quote and we go talk to our customers, we don't have a lot of discussion of, well, you guys are running at 12.6% operating margin today. We don't. You know what the conversation really is? It's three things. Are you competitive in this quote from a cost and price point of view? What's your value equation of what I'm getting for it? So I'm going to spend this, what fuel economy benefit, what emissions, and have you got the best technology? And I can assure you, if you don't have those three, it doesn't matter whether you're making 6% margins today, 26% margins, you don't get the business. And if you got those three, you will. And I think that's an important perspective. So it keeps coming back to both of our points. We've got to have great technology, which Chris is showing you. We've got to be very, very cost competitive, and you've got to drive it.
So we'll do Emmanuel on the third row.
Thank you very much. Just wanted to follow up on the earlier questions on the competitive landscape. I think you've been very consistent that the landscape is pretty similar in electrified vehicles as it is in combustion engine. What are some of the drivers behind the lower assumed participation rate? Is it, if it's not sort of like more competitive, is it just a function of different technologies where you still need to acquire? How should we think about the, half the participation rate in EVs versus combustion?
You're talking around the 15% number maybe on pure electrics. Is that kind of where you're thinking?
Yeah, or even the 26% on EVs.
Yeah. I mean, the reason actually is pretty simple. When we've been in combustion for about 80 or 90 years now, and so we know that space very, 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 very well. It's a pretty well-defined space. And we typically run in our market share on combustion products typically runs in the low 20%, low to mid 20%. With electric being a little new, a little different, the competitive field, to Joe's question, hasn't kind of finally laid down yet. It's still a little bit evolving. We've just assumed a lower market share rate of about 15%, and we've applied some of that logic on the hybrid products as well. It's not that we're not confident. It's just that there's just more variables there than what there is on an established product line like a turbo or a DCT, where it's established and been in place for longer term. That's all.
Okay, understood. And then when I look at your sort of midterm target, 7% growth rate, organic growth rate till 2020, do you see any big variation between your two groups, engine and drivetrain? Is one of them going to carry the growth somewhat more than the other based on the contracts you're quoting? And then same question around the margin upside. Obviously, with your mid-teen incremental margin, it feels like the margin upside would come from drivetrain, but is there also opportunity in engine?
Well, I'll do the growth piece, and he can do the margin piece, right? And obviously, I should have said this earlier. We'll give a lot more color in January when we give our backlog announcement, where we can get into products and segments. But I think in general, Emmanuel, we're seeing the growth trajectory is higher on drivetrain than it is on engine right now. We're seeing that this year as well. We saw it last year. I think there's more content opportunity, particularly around the hybrid vehicles. So we've got a little more outgrowth on drivetrain than we do on engine. I think that's a fair assumption. But
yeah, I would just add, because of the outgrowth in the drivetrain area, you're going to see more rapid margin expansion in that area and more moderate in the engine side.
Yeah.
I think we got one in the back there.
Thanks. It's Richard Hilgert from Morningstar. Hi, guys. Last year around beginning of November, we had a discussion around one of the things we talked about was pricing that was going on in the electric motor business, and you had expressed some concerns about some of the areas there, the pricing not being as strong as you thought it might be or should be. My question is with the intellectual property that we see out here, especially the traction motor with the intellectual property with the S windings, and with the way that the motor is configured with the windings on the inside of the stator. And the manufacturing process having some intellectual property to it as well, and how to do the windings. Are you seeing some improvement in some of those areas? And I would imagine that with some of the automakers looking to get into this kind of business, that's going to throw a little bit more of a dynamic into the equation too. Can you talk about how the market's developing right now?
I'll talk about the cost improvements, and maybe, I don't know, you can talk about the intellectual property portion of it. Remember, we just, when we met in the fall, we just recently purchased the Remy business, and it took time for us to understand their operating model, how they look at cost reduction, so on and so forth. And what I was referring to is that we have a different operating model. I won't go into details. I'm much more comfortable today now that we've put in our plant managers, our operating models in that business, our quoting process in that business, that the cost structure will get to the incremental margins because they know what the expectations are. And I'm very comfortable that we'll be very competitive when it comes to quoting drive motors going forward in that business. Now, when it comes to intellectual property protection, maybe, Chris, you can talk about winding and where we're at on that side of the business.
Yeah, so I draw the analogy to turbochargers in some ways. Last year we launched 100 different turbocharger applications, 100 new programs last year. And with each one of those, you have the opportunity to improve things and take weight out of the turbine housings and to improve the turbine efficiency. And we have 100 opportunities to do that. The same is going to happen on the electric motor side, right? That we're going to, as we're winning more business and we're and growing, we're going to have that same opportunity to do it much more than the guys who insource it. If you look at the guys who've tried insourcing turbochargers, they've not been real successful at it. So on the electric motors, I think it's going to be very similar. We're going to be having so many opportunities to improve, and we also have the visibility from many different automakers, right, that I kind of talked about, that we see what's going on in many areas, and we'll be able to innovate because of a requirement for this automaker, and then we can bring that across the whole spectrum. So hopefully that answers your question.
David up front there.
Yeah.
Yeah. Hey, thank you and good morning. It's Dave Tamburino from Goldman Sachs. My question for you is you've showed that continued growth through 2020, and then it should potentially accelerate through 2023 with some of the opportunities that you discussed, Ron. How does that change in a world, at least from a North America portfolio, if we did freeze the 2021 standards from a CAFE perspective for you? I mean, does it help accelerate? Is that more of a headwind to the business? How do you think about it today?
I can answer that, David, but since I have actually Chris up here, because I answer that question a lot, I'll have Chris, who's more versed in that area than I am.
So, I mean, I showed the chart that shows the standards globally are kind of converging. Freezing at the 2021 standards effectively doesn't really change much in the US. The mix might change slightly just for the US, but 75% of our sales are outside the US today, right? So, for a company overall, I'm not sure it's going to make much of a difference. And that small mix difference that you might see in the US with a 2021 standard, that's not all bad, right? That might actually let the industry really adapt to make some of the solutions more cost effective and be able to bring them to market. So I'm not sure it's going to impact us a whole lot.
Globally it won't, but on the US market itself, all it's going to do is probably what combustion would drive a little bit longer, right? And maybe hybridization, electric could get pushed out. So again, this gets back to what James said, we're agnostic. You might just drive combustion a little bit longer in North America.
You also need to think about our automakers they're putting capital in place very soon for 2021. And then their plans are already made. So could they delay them a little bit? Maybe, but they're still heading down that road. And they're global automakers as well. They have to produce products on a global basis.
Understood. Thank you. And then just a follow-up more from a capital allocation strategy going forward. When you think about power electronics, you're now, in agreement to acquire Sevcon. Would you look at, some of the other potential power electronics businesses that might be wrapped in a bigger piece that's being spun off of a competitor? Is there at some point or price, does that look like a portfolio of a business that you think you could merge or acquire? Or is that just doesn't make any sense for you?
No, I think, let me give it's a good question. We're really pleased with the progress we've made around electronics and power electronics in general. The organic activity has been ramping up very dramatically over the last 2 or 3 years. That's been positive for us. And then with the pending Sevcon action, that moves the needle further again in a positive direction. Our focus right now, honestly, is to get the Sevcon deal over the line, get that done, get focused on integration. But I would say as we look forward and look out over the next 2, 3, 4 years in terms of the acquisition environment, power electronics or electronics is definitely an add-on for us. It's unlikely that you're going to get a pure play when you look to get electronics. Even Sevcon on a small scale, has some battery charging technology, which is really interesting for us. So we would anticipate if you do that, you're going to probably get other stuff coming with it. But that's kind of where we're at. And I would say in general, our focus, our target area is, $200-300 million transaction type deals are kind of the sweet spot for us, which is what we've done in the past. So I think that's where we're heading over the next few years.
I think we have a question in the back there on the outside edge. Brian?
Just along those lines, if you talk about how the Sevcon deal came together, and maybe how many more Sevcons in this $200 to $300 million range you see out there, and how many are growing to that point where 3 to 4 years you may have a bigger pond in which to fish?
Yeah. So the way the Sevcon thing has come together has been pretty interesting. We had a dedicated team actually in the company working on what ideas and opportunities would be out there to strengthen our electronics capability. And there was a few names that kind of surfaced that met a lot of the requirements that we had. And we had an opportunity to work collaboratively with Sevcon, with customers actually, on quoting some of these integrated electronic propulsion systems. And really we're very impressed with their technology. And on the basis of that relationship, we were able to move that forward and, as I said, anticipate closing in Q4. There are others, Brian. There's other types of Sevcon type companies out there. Again, it's not always a pure clean asset, meaning automotive, power electronics capability. You'll probably get some other end market or other products that come with it, but that's something that we're actively looking at and open to do more going forward for sure.
We've got one more there, and then we'll finish up on that side.
So sort of, thank you, kind of going off of the M&A questions, and I guess just from a broader capital allocation perspective, how do you think about the balance sheet? I think it's very conservatively capitalized, and I guess if the right opportunity from an acquisition perspective were to come about, would you think about increasing leverage further, and kind of how committed are you to current credit ratings?
Yeah. So we take a good look at the balance sheet, and we are proud of having a strong balance sheet, especially given the industry that we're in. Would we stretch it from where we're at? The measure we would use would be debt to EBITDA, right? We're currently about 1.4 gross debt. The credit agencies, for the most part, are happy with this at 1.4, 1.5. They get nervous when we get around 2. Would we stretch above 2 if the right opportunity came along and they came at 2 to 2.4? Would we, if we had a path to show how that would come back down to under 2, the credit agencies most likely would, most of them, would work with us over a couple-year period. We demonstrated that with the Remy acquisition. We went slightly over 2. We laid out an exact plan how we're going to get back to where we're at, and we executed that plan. So yes, we would stretch it, and then we'd probably leverage back down. Our perspective, where we're at today is probably the ideal spot, but to be realistic, you can't stay in that spot for various reasons. Acquisitions come chunky, and then we have to deploy capital in certain ways. But where we're at today, we're in a sweet spot right now.
We'll finish up over there.
while the future looks very nice on the hybrid and the EV side of things, I have a question on the combustion side more than near term. You've seen more cities in Europe moving towards, excluding diesel vehicles coming into them. If that trend was to accelerate, and recognizing you have content on the gasoline and the diesel side of things, but if that change was to happen quickly, your win rates obviously now on the diesel and gasoline side might prevent you from getting quick gasoline share, let's just say, if that change happened quickly. How would that, do you see that happening, and how would that impact you on a share side of things if the customer choice in Europe, per se, quickly change from whatever the mix is in diesel to gasoline to significantly more gasoline in the next 2 to 3 years?
Yeah. Yeah. So a couple of thoughts, and then Chris can weigh in. We do see that diesel shift to gas continuing. We're looking at roughly 400 bips of shift this year from diesel to gas, and we see that trend continuing to go down. So we do see that. What we're seeing is those diesel engines are basically been offset or replaced with advanced gasoline technology. So over the next 2 or 3 years for BorgWarner, that's agnostic. I mean, we'll have the same content on those advanced gas engines as we do on diesel engines. So we got a little bit of noise in the next year or two, but we're agnostic between that diesel and gas at 2 or 3 years out. What's occurring a little bit now is particularly the European OEMs are seeing this play out and are trying to figure out where they pivot to and how quickly they shift to. A pure electric vehicle platforms is unlikely to be the short-term answer because that's a longer lead time to get that infrastructure and technology in place. So I would say over the next 3, 4, 5 years, what you'll see is adoption of more hybrid vehicles, apply more 48-volt mild hybrid architectures, as Chris alluded to earlier. And when you look at the screen that's in front of me, that works for me too. Actually, if we shifted more to hybrid and electric, it's okay. So we're in a good spot balance-wise. We're very, very close to the OEMs, though, as they figure this thing out, because there's a lot of, they've got a lot of installed capacity. They've got a lot of infrastructure issues. They will reach a limit on gas engine capacity for some of them. So it's dynamic and it's playing out. We're in those conversations trying to help them figure that out, what's the optimal solution. But the net for BorgWarner, I'm not worried at all, honestly, because diesel gas mix isn't going to hurt us. And if we accelerate to some more hybrid platforms in the short run, I'm good with that as well with $240 of content.
So I was just going to make a comment on some of the stuff that you have in the press about the individual cities making claims about banning diesels. I was in Brussels about 5 weeks ago, meeting with the European Commission on CO2 standards, and they're very clear that they're not going to let that happen. What they will let happen is that the cities can choose a emission standard. So they can say it's a Euro 6 standard, or Euro 6C with the real driving emissions, or Euro 7 or 8, whatever comes next. They will allow cities to say that they can have an emission standard, but they will not be allowing the cities to pick technology winners, which I think is the prudent thing. Otherwise, you're going to get anarchy, right? So
that's good.
Hopefully that clarifies it.
That I think we're done with Q&A. James, you want to make any closing remarks?
Yeah, no, I think we're kind of at the end. We're going to stick around, obviously, for a little while here, so we're not going to rush out of the door. So we're available for more Q&A offline, so we're not rushing anywhere. I just want to thank you all again for coming, seriously. You guys are all busy people. You've got a lot going on. It's a Monday morning. Trains don't help. Weather doesn't help. All of that stuff kind of works against. But you've come in and stuck with us for the last 2.5 hours, and we truly appreciate that. And hopefully, as you walk away, you're just going to walk away with the message that we try to lay out here. This is a company that's got a great history. We're in a really good spot. We're going to be agnostic around combustion, hybrid, or electric. We're going to be the leader in propulsion systems. We're going to deliver mid to high single-digit growth, convert that through to the EPS line, and long may the story continue. So with that, thank you. Is there lunch for folks?
There is. There's lunch.
There's lunch on the way out, but we'll be around for probably another hour or so if you want to have any offline conversation. Thank you.